Hello everyone, welcome to today's session. So today we are going to continue our chapter number 7. Okay, so before we continue chapter number 7, any doubts? Anyone has any doubts? Any doubts? No? Okay, so if no doubts, then a quick recap of what we have discussed in the last session. So I will ask few questions from you guys, and then we will proceed ahead with the further discussion. But few questions on what we discussed in the last session. So can anyone tell me what was the structure of the audit report? How we start the audit report? What are the things like start 4 to 5 sections of the audit report? What are those? Anyone?
Good evening, sir. First
Good evening.
title.
Yep.
Title it will be independent audit report. Then we will say the addressee, the shareholders of that so and so company.
Hmm.
Then the opinion we will give. Opinion, and if it is a clean opinion, then opinion, then basis of for opinion.
Hmm.
If they modified, then modified opinion, and basis for modified opinion, like that. Then related to going concern, materiality, uncertainty related to going concern. If anything is there, we will incorporate that as well. Next, key auditor matter, then other information, then responsibility for financial statement from the management side, and the auditor responsibility for the audit of financial statement from the auditor side,
Yes.
and yeah, on the other information and the legal responsibility, then signature, then date.
Yes. Absolutely correct. Very good. So yes, that was a structure that basically we discussed of the basic elements of the auditor's report. So these are the basic element with the title, addressee, auditor's opinion, basis of opinion, going concern para, key audit matters, other information, responsibility for financial statement, auditor responsibility, then management responsibility, then other responsibilities which were there. Then at times you have the legal and regulatory matter on which it is required to be reported. The auditor is required to report. Then signature, place, and date. So these were the basic elements that were present with respect to the audit report.
So
Clear?
we'll all
Hmm.
suggest, we'll also mention identify the financial statements which were audited. That was missing from Samyanathan's.
Yes, yes. So in auditor's opinion, you have sub things to specify: name of the company, the financial statements to be identified, each statement to be identified separately in that, period of that statement to be identified. So all those things were part of the auditor's opinion where you need to specify and identify these things. Absolutely correctly said.
Sir, can we change the order of this or same we have to write this?
No, unfortunately, you cannot change the order because this particular order is there for a specific reason, like to enhance the understanding of the readers. So you cannot change the order unless and until there is another format which is prescribed by the law. See, sometimes, let's say, for example, you are doing an audit and there is a specific format that is prescribed by the law. We'll come to that point when you cannot follow this format or there is some other format which is prescribed by law. At that point in time, what should be done?
Okay, thank you, sir.
Any doubts till now? Okay. If no further doubts, let's proceed. See, Now, there are few things specific to the opinion that I want to take it up, okay, and which are necessary for our understanding. Like, okay, once we have this opinion, once we have formed the basic elements, what to do further? Like, is there any further responsibility, or there can be further scenario where we have to modify our opinion, modify our report? So one of such example where audit report is prescribed by law or regulation. So can anyone tell me an example where you can say that, okay, there is already an audit report which is prescribed by law and we do not follow this structure?
CNAGs means
Okay, CNAG. Uh, Someone is saying banks. Ayush is saying banks. Okay, yes, Ayush, banks. What else? Long form audit report, Sanjay. Yes, good. What else? Any other audit report that you think where you have a predefined format, and instead of this particular paragraph system, we need to use that predefined format? There is one such audit report. Yes.
special purpose framework.
Uh, Not necessary special purpose framework, but it is a separate standard for that. I'm talking about normal audit only. Uh, Ayush, you're saying Karo. Okay. Anyone else with some different answer? See, Caro, long form audit reports are kind of the additional reporting that is done. It is not the audit report. Any audit report that you think the format is prescribed, and there is one. In one of the audit, there is a format prescribed. You need to issue report in that particular format.
Government audit, sir?
Where you follow the standards also. Not forensic audit, Ayush, because again, you do not follow SA when you do a forensic audit. Okay, I'll tell you. So basically, it is none other than tax audit, Form 3CB, 3CA. Yes or no?
Yes, sir.
So a common audit report that we might have dealt multiple times till now. So tax audit report, that where we do the audit and we have to issue, let's say it's not a company, you are doing the tax audit. It's not a company, but you are doing the tax audit. At that point in time, you issue audit report in the form of form. Anyone?
3CA, 3CB, 3CD. If it is 3CA form part of the companies, for other 3CB will come.
Yes.
3CD is part of that, both.
3CD is the additional matters. So that is altogether different. But yeah, 3CA and 3CB. If it is not a company, then 3CB. Otherwise, it will be a 3CA. Okay. Now, 3CA, 3CB. Okay, let's say 3CB. Now, if there is a 3CB, will you go the format which is there in the 3CB, or will you go with the format that we discussed just now? Obviously, 3CB. You will issue the audit report in the format of 3CB. Okay, now over there, you can say that the audit report is prescribed by law or regulation already. So in that case, what we should do? How you will comply with this particular part? How we will comply with the structure that we discussed till now? Anyone? How you will comply with the structure that we discussed till now? No? Okay, I'll tell you. So SA 700 already has a provision for that. SA 700 says that if the audit report, which is, auditor is required to issue, it is prescribed by law. If the auditor is required by law, okay, to issue a wordings of the audit report in such a way, in a predefined way, then at that point in time, he should specify and he should look into whether these things at minimum are there or not. And which are those things? One, a title. Second, addressee. Third, opinion section containing an expression of opinion. Okay. Fourth, identification of entity's financial statement. Fifth, a statement that auditor is independent, ethical requirements are met. Okay. Six, a section that addresses with respect to the 570. If you identify anything, then you have a section for that where applicable. Where applicable, basis for qualified opinion. Where applicable, to include key audit matter paragraphs as per 701. Okay. Then, where applicable, a section that addresses SA 720, other information, a description of management's responsibility for preparation, presentation, and everything that we have discussed, a reference to the essay, auditor signature, place, and date of audit report. So these are the things that are at a minimum you need to look into whether it is present or not. And then only he should specify in the report that the report is issued as per the standard. At minimum, these items should be present. Yes or no? Any doubts with respect to this one? Any doubts? So here, by this way, we are able to comply with the other form of audit reports also, which are prescribed by law. If there is an audit report prescribed by law, if these minimum items are present, then you can go and say that, okay, this particular report has been issued as per SA under SA 700. Clear? Yes, obviously. So whether you didn't part of this items, yes, for UDNC is a mandatory requirement. Okay. So you have to issue UDIN or you have to specify UDIN when you are issuing an audit report. That is for mandatory. Okay. Now, what if these items are not present? What you will do? Anyone? If these items are not present, then what you will do? That's the main part you need to understand. If these items, like the ones we discussed, are not present, what you will do? Anyone? No?
Then we will incorporate all these items.
But the format is prescribed by law. You cannot change it. So in order to incorporate these items, you have to change the format, but the format or the wordings are prescribed by law. How will you change it?
As per which applicable framework, sir, you are talking about?
I'm saying, let's say you get an example, like, a hypothetical example where the format which is prescribed by law does not contain all this information.
Then if the format is provided by them, we have to use it and provide the report as per their format. We need not change anything for that.
But these minimum items which are specified in the standard, if they are not present in that prescribed format of law, what you will do?
We have to follow the law. Law is the final right.
So in that case, yes, you have to follow, you have to issue the audit report. Okay. But in that case, there is one thing that you need to understand. When we are saying that audit report, this particular report or the audit was done in, as per standard. So at multiple places, we are referring that, audit has been done as per the standard. At that point in time, we will not refer to these standards. If these minimum items are not present, then you are not required to refer to the standards on auditing, because these minimum items are necessary to specify those things. Clear? So
Okay, sir. If so, then that would be the special purpose audit actually. See, if it is not followed that is prescribed format, then it will be the special purpose.
not special purpose. See, special purpose is altogether different, because special purpose are kind of, from the day one, the framework is altogether different. So when I say special purpose financial statement, they are prepared as per the special purpose framework. But here we are not talking about special purpose framework. We are just talking about the format of the audit report, the reporting part. Financial statement are as usual, general purpose financial statements.
Okay, sir. You are asking that when there is a general purpose financial framework, in that specified format is not adopting, then what is the position? That is your question, right?
Yes. So at that point in time, as I said, in our audit report, we have one paragraph where we refer to the standards on auditing. At that point in time, we are not required to refer to that particular point in our audit report. So if I show you, this was one of the audit report. If you see in this particular audit report, okay, we conducted our audit in accordance with the essay. We are referring the essay, that we have conducted our audit in the, as per the essay and rest of the things. At multiple places, we are referring on the standards. When the audit report format is not appropriate, like the minimum items are not present, at that point in time, do not refer to the standards. Do not refer and say that the audit report, is as per the standards. It is not, because standards has minimum specified things that are required to be mentioned. Clear? Any doubt on this part?
No, sir. Clear, sir.
Okay. Now, let's take one question. By way of a question, we will understand one more topic. Okay. So this question will help us to understand one more topic with respect to audit report only. The question is, you are CA Meera, the engagement partner. Let's read it. Wait a minute. If you don't hear the sound, then let me know. Okay.
You are CA Meera, the engagement partner for the statutory audit of Indogerman Auto Parts Limited, an Indian subsidiary of a German parent company, Auto Welt AG. The audit of the financial statements for the year ended 31st March 2025 is being conducted for two purposes. For statutory filing with the Registrar of Companies in India under the Companies Act 2013. For the purpose of consolidation by the parent company in Germany, whose group auditors require the audit of the subsidiary to be conducted in accordance with international standards on auditing, ESAS.
So now in this particular question, there is a company whose audit being conducted. Now the purpose of audit, like here if you see, it is conducted for two purposes. Number one, that is for the filing with the ROC. Number two, that is for the purpose of consolidation as per the international auditing standards.
CA. Meera and her team have performed the audit by applying the Standards on Auditing (SAS) issued by ICAI. They also performed certain additional procedures to comply with the requirements of ESAS. There were no conflicts between the requirements of SAS and ESAS that would have led to a different audit opinion or the inclusion of an emphasis of matter or other matter paragraph. CA. Meera has concluded that an unmodified opinion is appropriate. While drafting the audit report, she is unsure how to refer to the two sets of auditing standards. She prepares a draft basis for opinion paragraph as follows.
So now, because two set of standards were followed for the auditing, they don't have any conflict per se. So what they're doing is they're drafting the audit report for based on the two sets. Okay. And this is the opinion paragraph that she is preparing. So what they are saying with the opinion paragraph is this one. Yeah.
We conducted our audit in accordance with the generally accepted auditing standards. Our responsibilities under those standards are further described in the auditor's responsibilities section of our report. We are independent of the company and have fulfilled our other ethical responsibilities.
So this is what they have entered into their basis of opinion paragraph, that audit is conducted in accordance with these standards. Their responsibilities are described in auditor's responsibility section, and they are independent of the company. Okay. Now evaluate the basis of opinion paragraph. Okay. You have to evaluate the basis of opinion paragraph in this scenario and tell me whether this is appropriate. I'll give you a minute. Read the entire question again and then tell me. So tell me now, what do you think? Is this opinion paragraph appropriate? Is this opinion paragraph appropriate?
So we will mention the international standards of auditing which we had made use of, and also further that there is no conflict.
Okay, good. Anyone else with something further to add to this? Anything further you would add to this? No, yes. So she should include other matter paragraph mentioning that we have included audit opinion on other audit report for consolidation. Okay. So other matter paragraph should be included in this. Anyone else with a different answer? Like qualification or key audit matter paragraph should be included for this or something else? Anyone? Like you may have an opinion that okay, let's include other matter paragraph specifying the other standard set of standards that are issued, or we should not refer to the other set of standards. There are multiple things. So how you would draft the basis of opinion paragraph here? How you would draft it? Anyone? It's pretty easy, trust me. So see here, what we will do is, if the the concept and the thing that we need to understand over is when the audit is done based on the two set of standards. Do you think you can perform audit based on the two set of standards?
No, sir. When they are reporting to the Indian company, when there is a foreign branches are available, that report they can provide in their foreign country. There is no issue. But whenever we are disclosing that applicable accounting standard, we have to follow as per the Indian accounting standards. The Indian essays, standards on auditing.
Yes.
The thing is that we will ask them to reproduce as per the applicable Indian standards on accounting. Then if they are not doing, then the consolidation person has to do that.
So you are saying that we should not refer to any auditing standards of any other jurisdiction or international auditing standards in our audit report. Apart from SA, we should not mention any other standards on auditing in our audit report.
Yeah, we can mention it. We can provide the cross reference to it.
If there is no conflict between that two standards, then we can refer it, means we can mention it.
Okay. So absolutely correct. If both of the set of standards are not conflicting with each other, number one, the first criteria is there should not be any conflict between the requirements of these two set of standards. Whatever the second set may be, the first set is a essay, okay, issued by ICAI, and the second set will be whatever it is. There should not be any conflict. Okay. Or there should not be a scenario where it would have led to a different audit opinion. For example, as per essay, you are giving modified, and some other set of standard would require you to give you adverse, disclaimer, or let's say unmodified. So there should not be any conflict, there should not be any different opinion, or there should not be any requirement of including any EOM or other matter paragraph. Okay, not to include EOM or other matter paragraph in the audit report because of that reason, because of that highlight or two set of standards. If that is the scenario, if that is the case, then yes, you can go ahead and mention the additional set of auditing standards that has been complied for the purpose of the audit. So in this case, auditor's report may refer to the essay in addition to the ISA, okay, or auditing standard of another jurisdiction, but only and only if these conditions are satisfied. First, no conflict. Second, no different opinion. Third, no EOM or OM paragraph. Fourth important condition is the minimum set of the items or elements of audit report. The another set of standards should not, provide that you should not keep the minimum set. So it should not be a problem in keeping the minimum set. Your audit report should have the minimum set. Then only you can refer the essay. Remember? So I can refer the essay in my audit report only when there is a minimum set of elements which are required to be there and should be there. So along with this, the minimum set or minimum elements should be present. Clear?
So one question.
Hmm.
So we are conducting the audit for which the group auditors require audit of subsidiary to be conducted in accordance with international standards on auditing. And supposing these requirements which you have specified are not present and there is a conflict, but we are conducting audit as per in those standards. So then how will we reconcile, sir? It is all
For
right to
separate
do
audit
that
report.
separate audit reports.
See, in that scenario, you cannot issue this audit report. That will be a altogether separate audit report, separate audit engagement. Usually, what happens is if you want to include both of the set of the standards in the same audit report, there should not be any conflict. If there is a conflict, you cannot specify that uh, particular set of standards in your audit report. Now, there is one big problem also in with this. The underlying set of financial statements are the one. Okay. And if you are using two set of audit reports, if you are issuing two audit reports based on the different set of standards, there could be a scenario where there is a different opinion. Now, again, can you issue a different opinion on a single set of financial statement? Over there, you need to seek a legal advice whether you can do it or not. Or you have to convert the another audit report as a audit report issued as per the SA 800 special purpose framework, special purpose financial statement, and then you should have a two set of financial statement. One is general purpose, one is special purpose. But you cannot do that. Okay, I have a general purpose financial statement. I'm issuing one opinion, clean, modified, or clean, unmodified, another opinion, modified or adverse. No. Same set of financial statements cannot have two different opinions.
So, sir, we can do one thing like in the case of consolidation, that just for the consolidation purpose, the statements are being prepared on IFRS basis, and separate opinion is being issued basis the international standards on auditing. That might be a modified opinion. But for India, as per prepared as per AS, General Accounting Standard, the IGAP, and for that we have unmodified opinion. So in that case, there would be no conflict, and that would be a acceptable position.
Yes. So for these kind of scenarios where the financial statement are prepared for the purpose of consolidation, at that point in time when we have already seen our Access 600, that you are given like principal auditor, let's say here in this case, principal auditor is there in the Germany. Now he will provide you what is your materiality. That materiality will differ from your materiality based on the standalone financial statement that you are going to audit, because that is a materiality coming from the group and consolidated financial statement. Number two, a misstatement might be material from the standalone purpose but might not be material for the group purpose. We have seen that when we discuss our SA600. So at that point in time, your materiality differs, your definition of material misstatement differs, your items which are required to be audited, risk assessment, everything differs, because a thing might be high risk area from the Indian perspective or standalone financial perspective, might not be relevant from the group perspective. Simple example, intercompany transactions which are required to be eliminated at the group level might not be relevant because they are going to be eliminated. But for the standalone purpose, they are a key factor. If the company is into majority of the related party transactions. So those are the things that will make a different set of financial statements altogether. and it will at that point in time you will be following different set of auditing procedures, and you can issue a different audit opinion.
All right, sir. So that would be a completely acceptable position.
Yeah.
Yeah, got it. Thank you, sir.
Okay. So now in this case, I will show you the draft opinion that is required to be prepared and how you should prepare. This is just a draft. Okay. Again, if something else is there, then it will change accordingly. But yeah, considering all the scenarios and everything, every information, this is the draft opinion that is required to be prepared. That we have conducted our audit in accordance with the essay specified under 143.10 of the Companies Act and the ISA, okay, issued by the international like assurance and standard boards. Our responsibility under those standards are further described in auditor responsibility for audit of the FS section of our report. We are independent of the company in accordance with the code of ethics issued by the ICAI, together with the ethical requirements that are relevant for to our audit of the financial statement under provisions of Companies Act and rules thereunder, and we have fulfilled other ethical responsibilities in accordance with the requirement of code of ethics. So this is how the basis of opinion paragraph should be drafted, not like what she drafted here, this one, small one. Clear? Any doubt?
Yes, clear, sir.
So by this way, we understood that in case if there is a different set of standards which are also followed on the same set of financial statements, not the different, but the same set of financial statements. Okay. Along with the essay, you are following different auditing standards. Either these are the international standards on auditing, or they are the auditing standards of any other jurisdiction. You can mention, auditor can refer to the standards on auditing in addition to the international standards on auditing or other of such other jurisdiction, provided no conflict between those two. Okay, that would lead to form a different opinion. Okay, or not to include emphasis or other matter paragraph that in particular circumstances are required by the essay. If this is a scenario, fine. And then the minimum items or minimum elements which are there should be there. Then only you can refer, otherwise not. Also, there is one more requirement, that is to mention the jurisdiction of origin of the other auditing standards. Jurisdiction of the origin of other auditing standards. Let's say, for example, here in our case, it was the international auditing standards. Okay. Then we specified international auditing standards issued by whom. So that was something you need to specify. What is the origin of the other standards? In our section that we drafted, we specified that the standards were issued by the International Auditing and Assurance Board, like that is what there. Okay. So you need to specify these things at the minimum. Okay. Now, one more topic I want to take up on the audit report. Okay. And let's say, for example, I'll take you to the audit report itself. See, this is the audit report and rest of the content. For example, let me take you to a particular part. Let's say this is the rest of the part of your annual return or annual report. Okay. Now tomorrow, if company, what company does is, let's say hypothetical example, not actually done in the past, by anyone, but let's say this particular statement is there. Okay. What company does is, this statement, they take it up from here, this particular statement, and then they add this statement next to the financial statements, so that it should appear that this is part of the financial statement. So I'll quickly add this statement next to the financial statements so that you guys can understand. Okay. Let's say it has been added after the consolidated cash flow statement, stakeholder engagement and materiality assessment that has been added, and then rest of the things are there. So this particular page has been added after one of your statement to appear that it is part of the audited report, audited financial statement. Now what you will do? Something which is not part of the audited financial statement is being added as a audited financial statement, stakeholder engagement and materiality assessment, something like that. What you will do in this scenario?
So, sir, we have one standard is there, 720. Auditor responsibility and other information related to the financial statement.
Okay.
See, in addition to the financial statement, whatever the reported in the financial, that auditor, that financial reporting, see, other than like BSR, CSR activity and other information like this, we have to we have to verify these also, and we have to check all this as per the that SCA 720. We have to do the reporting.
Okay. Anyone else with a different answer? So we have to check this and accordingly we need to issue the report. You are saying. So we have to audit this and then based on that we have to issue the audit report. Anyone else with a different answer?
Sir, we will not give any conclusion or any reporting on that. We will identify any mistake is there. The reason is that whenever they are using the financial information into the other information, say example the CSR activity, the gross profit is so and so, the 2% what we say. If it is a turnover is more than 1,000 crore or net worth is 500 crores, whether how they worked. See whether the same information is pulled from the financial statement and when they incorporated into that CSR activity, whether it is appropriately represented or not. To that extent, we have to check and verify and we have to provide this information.
So let's say that is matching. For example, this particular part that you are seeing over here, let's say
Make
this
it
is
check.
that is
Make it check.
matching.
Yeah, matching.
Yeah. So how will you like, for example, if this is matching, sorry, it went back to that. Let me quickly go to that section. Let's say if it is matching, then in that case, how will you address in your audit report? The question is, how will you specify this in your audit report that it is matching? Or you will not mention anything in the audit report? Very good, Sanjay. So I'll tell you here. First of all, understand whether this is the part and parcel of your, what is happening? Sorry. Whether it is a part and parcel of your audited financial statements or general purpose financial statements. Okay. If yes, then only you go and ask management to include this. See, as of now, what is happening is by specifying this information over here, what is appearing is this supplementary information. First of all, we call this as a supplementary information. Okay. Now, this supplementary information, which is presented with the financial statement, if it is required by the applicable financial reporting framework if required. Let's say after the financial reporting framework says, okay, after the audited financial statement, add these things at an additional, or you can add, or management has an option for. So financial reporting framework gives an additional option to add some more information. Now, there could be a scenario like this way, where applicable financial reporting framework does not require this. So you tell me whether stakeholder engagement and materiality assessment is a part of applicable financial reporting framework? Yes or no? Is it a part of financial reporting framework? Yes, no, can't say. Whether stakeholder engagement and materiality assessment that is done by the management is part of the applicable financial reporting framework. Have you seen this in any other audit report? No, it is not part of the applicable financial reporting framework. See, whenever we prepare the financial statement, we write one line, the schedules, the accounting policies, okay, form integral part of the CFS, or like consolidated profit and loss account. The significant accounting policies and notes to account forming part of consolidated financial statement. You specify these things. Okay, the schedules referred to above and accounting policies, they form part of consolidated financial statement, and that's why we go and see the schedules down, this schedules part, which is integral part. Now the question comes is this mentioned anywhere in your financial statement? Answer is no. It's not part of schedules, it's not part of notes, it's not part of accounting policy, it's not part of statements. That means it's a supplementary information. Information which is not required by applicable financial reporting framework. Now you need to understand whether it is an integral part or not. Most of the time, majority of the time, if something is required by financial reporting framework, you have to consider that reporting in your audit. But if something is not required by financial reporting framework, at that point in time, that information should not be presented with the financial statements. Okay, so if it is not required, do not present with the financial statements. Do not consider this as an integral part of audited financial statement. And ask management to specifically either differentiate this by keeping somewhere else, or specify that these are the unaudited supplementary information. It should be unaudited. Management has to specify unaudited if they are presenting with the financial statements. Otherwise, ask them to differentiate this particular information from your set of financial statement. If management refuses to do so, you specify in your audit report that this is the supplementary information on which we have not issued any opinion. Either management has to specify this as an unaudited, or management has to take somewhere else different from the financial statement. If management refuses to do so, you as an auditor specify this information is not audited, you have not issued any opinion in your audit report, so that the reader can understand this is not part of financial statement, this is not audited, and auditor's opinion is not on this particular information. Clear? Any doubt? Any doubt on this?
Clear, sir.
Okay. So that was another one important area which is known as the supplementary information. So supplementary information, if integral part, like in that particular scenario, will not say a supplementary, okay. But you need to understand whether that supplementary information presented with the financial statement is required or not. Usually, supplementary information is not required by the applicable financial reporting framework. Not required. Okay. Now you need to understand, are you issuing an opinion on that? Whether your opinion covers that information, or is it something presented in between of the financial statements just to trick the users that okay, this is also audited information. Okay. If not required by the applicable financial reporting framework, not considered integral part of the audited financial statements, then ask management. Management, please change how the unaudited supplementary information is presented. Take somewhere else. If they refuse to do so, in that case, you can specify that in your auditor's report that such supplementary information is not audited. It has to be sufficiently and clearly differentiated from the audited financial statement. Clear? Okay. So that was with respect to some important areas that I wanted to cover on the SS 700. Now, we would go back and do a quick revision of company set. Remember, we discussed on the company set section 143 yesterday.
Yes, sir. 143.1, 143.3 we discussed, and Rule 11.
Yes, absolutely. Rule 11. So let me go quickly on that. Just a minute. Yeah. So we discussed about section 143.1, 143.3, specific reporting areas also, like information, books of accounts, branch, FS versus books of account, AS compliance, adverse transactions, director disqualification, any other qualification, adverse remarks. Then IFC, we discussed about the Rule 11. So all these things were already discussed yesterday. Now I want to discuss one important reporting area, that is the CARO. CARO reporting. So before I proceed with the CARO reporting, can anyone tell me to whom the CARO is applicable? Let's talk about first the CARO applicability. So,
It
can
applicable.
anyone tell? Yeah.
It's a listed company, and listed company is mandatory, sir, and also that one main company is not applicable. Section 8 company is not applicable. Insurance company, banking company is not applicable. For other company, there is a limit is there, that paid up share capital 1 crore, turnover
Hmm.
and loan outstanding is there. But small companies also is exempted in CARO reporting. For small companies, the turnover is 4 crore, the paid up is 4 crore, and turnover is 40 crore is there. In that aspect, when you are looking at the private limited company, that other company, the value is small, even in the 2020.
Okay. Very good, Sanjay. Yes, absolutely correct. Your answer is also correct. So the easiest way to remember CARO applicability is this one. BIOS 8P. BIOS 8P is the easiest way to remember the CARO applicability. That includes banking, insurance, OPC, Section 8 company, that is S8, and the P stands for the private limited. So these are the ones who are exempted from Caro. Yes or no? But private limited exemption is something different. Private limited exemption is something different. Just one thing here. Sorry, I'll just pull it down. OPC, small company, section 8. Okay, so banking, insurance, OPC, small company, section 8, and private limited. But private limited has some conditions. These are exempted. Exemption is given to them, but private limited is subject to some conditions. So we need to understand those conditions. So can anyone tell me what are those conditions?
Sir, paid up capital 1 crore or more, loan outstanding is 1 crore or more, and the turnover is 10 crore or more. These are the conditions on the private company. If it is exceeding this limit, then it's applicable. However, there is a small companies also there. That small company concept, the paid up capital is less than 4 crore, and turnover is less than or equal to 40 crores are there. The company also will have this limit. See, now in the private companies, capital is 1 crore we define, but in the paid up capital for the small company is defined as a 4 crore. In that case, the 4 crore we can replace, 1 crore we can replace with 4 crores. And also in turnover, if you look at that private limited company, it's a 10 crore is the limit, but the small company, the turnover is defined as a 40 crore. Up to 40 crore is not applicable.
Okay, absolutely correct. So let me explain in a simpler format how it works. Okay, so when it comes to the exemption, I divide into two sections. One, as I said, exempted. Private limited is subject to some conditions. Now, the condition, easy way to remember is P1, D1, R10. That is paid up share capital less than 1 crore, debt less than 1 crore, turnover, total revenue less than 10 crores. Okay. Now the question comes is how and when these conditions are required to be checked in. Okay. So paid up share capital is at the balance sheet date as on balance sheet date. Okay. As on the balance sheet date, we need to check what is the paid up share capital. This debt at any point in time during the year. And turnover, again, if turnover exceeds 10 crore during the financial year, at that point in time, it becomes applicable. Now, few questions with respect to this one. When I talk about paid up share capital, what paid up share capital includes? Can anyone tell me?
Reserves and surplus.
Okay. Paid up share capital will only include reserve and surplus or something else also?
Only reserves and surplus, sir.
Only reserves and surplus. Fine. Anyone else? What paid up share capital will include? Okay. So to understand this, we will go to the provision itself because the best way to understand what it will include, what it will not include, let's see the provision itself, which talks about the applicability of the report. So, to whom and when this particular report is applicable. Okay. Basically, if you go and see, if you will see the report itself, it is part of first clause, like the clause 1 of this order basically talks about to whom it will be applicable. It talks about that, okay, to whom this particular clause is going to be applicable, what are the exemption and everything that is given in the clause 1 itself. So if you go in clause C, clause 1, it talks about with respect to the private limited, not being a subsidiary of holding company of a public limited, having paid up capital and reserve and surplus. This is something we need to understand. Paid up capital and reserve and surplus. So the first question comes is this paid up capital, which is there over here, and reserve and surplus. Can I say this paid up capital include preference shares? Yes or no?
Yes, sir. Preference share capital will also included.
Is it a paid up share capital?
Yes, sir.
So paid up share capital is including preference share capitals. Remember that. Now, second question, reserves. Which reserves I will take? In reserve and surplus, which reserves I have to take?
Revaluation reserve will not consider, sir, anyway, I believe.
Okay. Revaluation reserve will not be considered. Apart from that, any other reserve that is not required to be considered.
Capital redemption reserve and capital reserve.
Okay. So here the reserve and surplus, if you see the order, there is no exclusion specifically given. So this will include your capital reserve, your revenue reserve, your revaluation reserve, and when I talk about the surplus, okay, when I talk about the surplus, it includes the debit balance also of P&L. So credit balance of P&L, debit balance of P&L, both will be included in the surplus. So these things are part of your reserve and surplus. So there is no exemption or no exclusion given that you should not count that. Understand? So paid up share capital, they use the word capital. It could be preference, it could be equity both. So you need to consider both of them. There is no exclusion also in that.
Sir, we will include the securities premium reserve account as well.
Every reserve. There is no exclusion from the reserve. If that is a reserve, yes, you have to include that. Then second, balance sheet does not have total borrowing exceeding from any bank or financial institution. Any bank or financial institution borrowings. Now, how do you classify borrowing? What is borrowing? What is borrowing here?
Long-term borrowings.
Okay, long-term borrowings, like term loans,
Debentures.
like term loans, long-term borrowings, like term loans.
Yes.
Yeah. Apart from that, any other thing to be included in the borrowings? Any other thing that I need to include in the borrowings? This idea. Some okay. Any other thing that I should include in the borrowings? Anyone else? What borrowing should
Debentures,
debentures? What else? Apart from that, what should I include? Working capital loans. Okay, very good. What borrowings will include? Very important question, because this applicability, if not clear, then how will you decide whether the CARO is applicable or not? Can I include short-term loans in these borrowings? Can I include short-term loans? Yes, no, can't say.
no,
No, short-term borrowing should not be included. Okay. What about cash credits, overdrafts?
not that either.
Okay. Outstanding dues in respect of credit cards. If a
No,
company has a credit card and an amount outstanding for that.
that's a short-term borrowing.
Hmm. So again, the term borrowing here is specifically prescribed in the way that it says only borrowings, total borrowing, total. It does not bifurcate between short term and long term. So any borrowing from bank or financial institution, which may include short term, long term, credit cards, and all those stuff, whatever it is, if it is a borrowing, if it is a kind of a finance facilities borrowings amount due to the bank or financial institution, it has to be counted. It has to be counted. Clear?
So, which include the guarantee given by that company as well.
Guarantee, see, again, the question comes is to whom you have provided the guarantee. Is it the borrowing from any bank or financial institution or a guarantee? Borrowing and guarantees are a bit different.
There are judgments.
Hmm.
There are judgments that borrowing and guarantees are different. In
Yeah.
income, there is a Supreme Court judgment to that effect.
So accordingly, we need to understand whether it's something where we have to pay the amount. If guarantee is something that the liability is not there, like it's not in your books. You do not recognize the liability for a guarantee. It is part of the contingent.
See, which means that the guarantees for one of the supplier, the company is issuing the guarantee. Guarantee is provided to the company. The supplier is invoked the guarantee. That time it's indebted to the that bank, right?
But if it is again, so has it been materialized? That you need to see. Is it something which is materialized where you have to definitely pay? I'm not talking about contingent. I'm talking about borrowings which are definite. If it is there in the books of accounts where you recognize the liability, yes, it will be a borrowing. If it is not being recognized till now, it cannot be treated as a borrowing. Contingent liabilities are not borrowings.
At the same case, the letter of credit as well. When they invoke the letter of credit, then the time the client are liable
Yeah.
to.
So borrowings include debentures also.
If it is to the banks or financial institution, so borrowings from the bank or financial institution, if you
Oh,
have
yes.
issued the debentures in the market and anyone has subscribed, it's a different story.
Okay.
Yes, sir. We understood that whether it is a short term and long term is not a matter. We have to include even the demand loan and like you said, that cash credit, export credit, overdraft, whatever the case may be. We have to include in that limit.
Now the second question comes is, what is the financial institution means? Will it include NBFC? NBFC? If I had taken a loan from an NBFC,
Yes, include.
can I say that NBFC is included in the financial institution?
Yes.
No, sir.
Yes, sir. We will include it, sir.
So NBFCs are part of the financial institutions. Okay. So financial institution will include NBFC. So yes, NBFC will be part of that financial institution. Now coming to the total revenue. Now, if you see for the total revenue, it says as disclosed in the Schedule 3 to the Companies Act, including revenue from discontinuing operations. Pretty much straightforward. It says total revenue, which is disclosed. Okay. So if it is a total revenue, whatever revenue you have disclosed in the financial statement as per Schedule 3, that has to be considered. So it says total revenue, not revenue from operation. So again, the question comes is like, as you there is one query, should we include other income? It says total revenue, not revenue from operations. Revenue from operations, major part, major income. But when I talk about total revenue, it includes everything. Other operating revenues will also be part of it.
Yes, sir. Even we will include that discontinued operation income as well.
Yes.
When there is a
So
revenue.
every kind of revenue, the total revenue which is there, including the discontinued, will be reported or will be considered for this particular 10 crore limit. Clear? So this is how you decide the applicability of Karo. Now, one specific question I want to ask from everyone with an example. Okay. So let's say there is a company, ABC Private Limited. ABC Private Limited. Okay. So the turnover of ABC Private Limited, let's say we are talking about financial year 24-25. So the turnover of ABC Private Limited, let's say 25 crores, total revenue, turnover, whatever you want to say. Borrowings by this private limited, borrowings of this private limited is, let's say, 2 crores. And then let's say talk about paid up share capital. The paid up share capital of this particular private limited is 3 crores. Tell me the Karo applicability.
Sir, in this case, Karo is not applicable, sir.
Okay. Anyone else with a different answer? Anyone else with a different answer?
Yes, all the three conditions should be satisfied.
No. Any one of the conditions satisfied, it is applicable. But in this case, why it is not applicable means it's a small company. See, in the private limited company, if it is small company means the turnover can be 40 crores. That paid up capital will be 4 crore. So considering that that condition, the Karo is not applicable to this private limited company.
Now, for that only, absolutely correctly said, that's why I created a bifurcation between these two categories. One exemption and second is subject. So first, I will go for the pure exemption. If any of the entity is falling under this category, then it will get pure exemption. That means no need to check for the subsequent part. If a private limited company is a small company, don't go for these conditions. Okay, don't go for these conditions in that scenario. But if a private limited company does not fall under any of the condition, then go for specific private limited condition exemption. So the condition for the small company, when I talk about a small company, so small company means a company like, having a turnover and paid up share capital of less than 4 crores and 40 crores. That is a small company. So if I write it here, small company as per 285 of the Act. Okay, 285 of the Companies Act basically talks about that paid up share capital less than 4 crores and turnover, okay, less than 40 crores. If these two conditions are satisfied, plus apart from this particular condition, the another condition for this is it should not be a holding company or a subsidiary company. A company registered under Section 8, a company or a body corporate governed by any special act. So this private limited, this small company can only, private limited company can only be small company when these two conditions are satisfied and it is not a holding, subsidiary, Section 8 and special company, which is governed by special act. Okay, if these conditions are satisfied, then only you can say, okay, this is small company. Otherwise, it is not a small company. Clear?
Yes, sir. Clear, sir.
Any doubt till now?
No, so for a small company, you said we will check this and for exemptions for others. What I didn't follow that.
Okay, so if this particular company here, if that qualifies for the small company, first check small company. This one, first check for specific exemptions. These are the specific ones, specific exemptions. First check for the specific exemption. If that is applicable, here in this case, this is the specific exemption, which is a small company. Irrespective of the borrowing, turnover less than 40, paid up share capital less than 4, it is a small company, exemption granted. No need to check further for the private limited exemption. Clear?
Yes, sir.
First check for the specific exemption. If this specific exemption is not applicable, then go for private limited. Because the wording itself says it in such a way. So you have like it shall apply. If you see the wordings of the CARO clause 1, it says that it shall apply except banking, insurance, Section 8, OPC, and then private limited. So if I go by the hierarchy which is given in the clause itself, one person in small company comes first and then comes the private limited. So first banking, insurance, Section 8, OPC, small company, and then if nothing satisfies, then I go for a private limited.
Sir, so why requirement this clause of private limited company?
Why this clause is given? Simple answer. Let's say I'll change this example and we will understand why this clause is given. I'll remove this for a time being. And borrowing, yeah, turnover. This one. Okay. So let's say it has a turnover of 7 crores, paid up share capital of let's say 0.5 crores. Borrowings, let's say again 0.5 crores or 50 lakhs. Instead of crores, let me do it lakhs. 50 lakhs and 50 lakhs. Now this is the another important aspect of here is ABC Private Limited is holding company of DEF Private Limited. Possible? Very much possible. Yes or no? So in this scenario, tell me which exemption will be applicable. Which exemption will be applicable? Anyone?
First one will not be applicable, sir, because it is a holding company.
Yes. So as we discussed, it should not be a holding subsidiary, Section 8 or special company to qualify as a small company. Apart from this particular requirement of your numbers, which is turnover and paid up share capital, you have to see for the holding and subsidiary also. And it does not say it's holding or a subsidiary of a public company. It only specifies that it should not be a holding or a subsidiary of any company. If it is a holding or subsidiary of a private limited, still it will not be applicable to them. Okay. So here it will not be counted as small company, but still the private limited company exemption will be applicable because turnover is less than 10, borrowings less than 1, and paid up share capital less than 1. So P1, D1, R10 is still applicable. So Caro is not applicable in this scenario. And remember the condition here are which are given in the clause itself talks about and. That means you have to satisfy all three conditions to claim this exemption. It is not something or either paid up share capital, either debt or revenue. No, all the three conditions should be satisfied. Clear? Not a small company, but private limited exemption available. Any doubt? Any doubt with this?
No, sir. Please, sir.
No, sir. Thank you.
Okay. So, if no doubts, what I propose is let's take a quick 10-minute break. After the break, we'll continue with the Caro. Let's take a quick 10-minute break. Yep. So we discussed about the applicability of the CARO. I think we are pretty much clear on that. Any doubt on the CARO applicability part?
No, sir. Clear.
Okay, great. So let's now move forward and discuss clause by clause the CARO, because then only we will be able to understand what CARO requires us to report as an auditor. So now we will talk about para 3 of the CARO. Okay, or para 3 of the order, which basically talks about which are the clauses or which are the things that we need to report as per para 3. Okay, so the first thing that para 3 requires us to report, the first important part of the para 3 is on the fixed assets. Okay, plant, property, and equipment. So clause 1 of para 3 talks about your reporting on the fixed asset. That says that whether the company is maintaining proper records showing full particulars, including quantitative details and situations of plant, property, and equipment. That means here we are required to report if they are not maintaining proper records of plant, property, and equipment. So PPE records. Then we are required to provide the same thing for the intangibles. Whether maintaining proper records for the intangible, here they have not asked for the quantitative details, because in intangible you cannot provide quantitative details. It's an intangible. So that's why intangible records without quantitative details. Then you are required to report whether these plant, property, and equipment are physically verified at a reasonable interval. Number one. Number two, if any material discrepancies were noted, then have they been properly dealt in the books of accounts? So discrepancy, physical verification, and adjustment. Three things in one single part. Okay, so physical verification, then material discrepancy, and the third one is your properly dealt adjustments. Okay, so these three things are there in a one particular part itself that you are required to report. Same, there is one more area that we are required to report with respect to the immovable property, that deals into the title deeds of the immovable property. Now we are focusing on the title deeds of immovable properties, other than the properties where the company is lessee, like other than the long-term lease, we are talking about immovable properties. Now, this clause requires us to report the details of the immovable property which are not in the name of the company, disclosed in the financial statement. Okay, so these are disclosed in FS, but not in the name of company. And you need to provide description of the property. You need to provide gross carrying value. You need to provide held, like the name which is there, in whose name it is being held on, whether he is a director, promoter, or relative, period held, like since when, and reason not being in the name of company. So title deeds not in the name of company. Okay. Once we are done with the title deeds which are not in the name of company, the next thing that we need to specify in the CARO is the revaluation of these property, plant, property, and equipment, including right of use of assets, which are part of your finance lease or intangibles. If there is a revaluation, then what is the revaluation basis? Like whether the revaluation is based on the valuation by the registered valuer, you need to specify if there is a revaluation, whether the valuation is done by revaluation done by a registered valuer. Then if yes, then like you need to provide that information. Number two, you need to specify the amount of change, which is 10% or more of aggregate of net carrying value of each class of plant property and equipment. As of now, just we will take an example also for this. Don't worry, because we will go example by example, but just understand as of now that here we need to specify first on the revaluation, then the basis, whether it is registered valuer or not. Number two, amount if greater than 10% of class. 10%, if the change is more than 10%, 10% or more in the aggregate net carrying value of each class, then specify the amount. So revaluation, the basis, and then the amount. These are the two things you need to provide. The last part of clause 1 of para 3.1, like this is only we are talking about para 3.1. Okay. Para 3.1 of Caro. This is 3.1, just 3.1. Here, from here, this entire is para 3.1, which is on the plant property and equipment. If you see, it is nothing but plant property and equipment related para 3.1. The last part of the para 3.1 talks about proceedings under the Benami property. Okay. If there are proceedings held under the Benami property, then those proceedings, details of those proceedings, we need to provide. If any proceeding has been initiated or pending under the Benami Transactions Prohibition Act for the Benami property, then you need to disclose the same. And you need to specify whether that has been appropriately disclosed in the details of financial statement or not. So Benami property, proceedings, and disclosure. Okay. So these are the points which are there in the first part. Any doubt with respect to this one? Any doubt? Okay. If no doubt, let us see the Caro itself, how it is reported.
Sir, I have one query. What is the reasonable interval time, sir, for physical verification of that?
See, reasonable interval, when it comes to reasonable interval, it depends upon the size and nature of the fixed asset. But again, if you talk about the term reasonable, it is not defined anywhere. It has to be counted at least once a year. Or if the plant property and equipment are of such nature, then it may be less than that. But you can say that reasonable interval at least becomes once a year. Okay.
Okay,
So
sir. Okay.
I have an audit report, but it does not contain the Caro. Can anyone tell me why? This is the audit report, but it does not have the Caro.
Because that is Caro is not applicable for them.
Why?
Maybe reason to be ascertained. What is the type of company we would see it?
You have the details in front of you. Why do you think Caro is not applicable to him? Why the Caro is not there?
It is a consolidated financial statement.
Consolidated. Let's go to standalone. Fine. And let's see over there.
Sir, it is a banking company. Kotak Mahindra Bank is not applicable.
Exactly. It's a banking exemption for the banking. So Caro will not be there in this particular one. Correct, Ayush. So you will not identify Caro reason because it's a banking company. Exemption from the Caro. I'll take another company then.
But as Sanjay advised, for CFS is Caro is not applicable except only one
No,
class. Only one class is
clause,
applicable for
yes,
Caro.
yes, but still it is applicable. I will not say it is not applicable.
Not applicable, but one class is applicable. That is 24.
Okay, so this is the Caro, which is annexure B in one of the publicly available data in the report. Okay, so now what it says, like we'll go to the point one, para 3.1. The company has maintained proper records showing full particulars, including quantitative details of the situation of plant, property, and equipment. The company has maintained proper records showing full particulars of intangible. The company has a program of verification of plant, property, and equipment to cover all items once every 3 years, in which our opinion is reasonable having regard to the size of the company and nature of its assets. So here they are saying that once in a 3 year is a reasonable. It's a professional judgment. Okay. But it is based on the nature of its assets. They have to determine whether it's appropriate or not. Okay. So reasonable interval, here they are saying once in a 3 year is perfectly fine. Pursuant to the program, certain items of plant, property, and equipment were due for verification during the year and were physically verified by the management. According to the information explanation given to us, no material discrepancies were noted on such verification. Remember, so point number B not only talked about physical verification at a reasonable interval, but it also talked about whether is there any material discrepancy and the adjustment. So there were 3 points: physical verification, material discrepancy, and adjustment. The all 3 points are being addressed in a single particular point over here. Point number B. Point number C, with respect to the immovable property, other than the properties where the company is lessee, disclosed in the financial statement, and according to the information and explanation given to us, registered sale deed, transfer deed, conveyance deed provided to us, we report that title deeds of such immovable property are held in the name of company. Okay. So that is given. Yeah, there is one point also that as disclosed, except for the lease on land, as disclosed in the note 1.7 to the standalone financial statement, in the respect of which the allotment letters are received and supplementary agreements are entered. However, the lease deed are pending execution. So if something pending, you need to specify in this way. Then revaluation, if there is no revaluation, you need to specify there is no revaluation. Okay. And the last one is Benami property. So if there is no Benami property transaction, so no proceedings has been initiated. Clear? So this was your point number 1. Straightforward. No complexities involved. Any doubt?
No, sir. Clear, sir.
Okay. Sorry. Yeah. So this was the part. This was the only just one paragraph, but again, this was important paragraph on your, you can say, plant, property, and equipment. Now we will go to para 2. Okay. What is para 2? We will go one by one. So para 2, point number 1. So para 2, point number 1 talks about with respect to the inventory. It says that
whether physical verification of inventory has been conducted at reasonable intervals by the management and whether, in the opinion of the auditor, the coverage and procedure of such verification by the management is appropriate, whether any discrepancies of 10% or more in the aggregate for each class of inventory were noticed, and if so, whether they have been properly dealt with in the books of account.
So it talks about inventory, physical verification of the inventory. Okay, I hope the sound was available, like audible. So physical verification of the inventory where it has been conducted at the reasonable intervals by the management. Okay. And based on the procedure and the coverage, whether it was appropriate or the not. So coverage and the procedure of such verification by the management is appropriate or the not. And if there are discrepancies of 10% or more in the aggregate each class of inventory noticed, then in that case, whether they have been properly dealt or not. So, one, physical verification. That too on reasonable intervals. Again, it's a professional judgment based on the size and the nature of the inventory. You decide this. Okay. Then coverage procedure. You need to specify the coverage procedure over here. And adjustment if greater than 10% of class. If these conditions, if adjustment is more than 10% of the class, you need to specify whether that has been properly dealt or not. So these are the things that you need to specify with respect to the physical verification of the inventory. That is one point. B, let's see the B point. So now we will see the B point.
Whether during any point of time of the year, the company has been sanctioned working capital limits in excess of 5 crore rupees in aggregate from banks or financial institutions on the basis of security of current assets.
So here the first point talks about only working capital limits in excess of 5 crores. Working capital limit, if they have been sanctioned, they are talking about the term sanction. Working capital limits in excess of 5 crores in aggregate from banks or financial institutions. That was the first point. Okay. And it has to be any point during the year. Now let's see the second part of this.
Assets, whether the quarterly returns or statements filed by the company with such banks or financial institutions are in agreement with the books of account of the company. If not, give details.
So here the second point says that these quarterly returns, statement files are in agreement with the books of account. Usually you have a quarterly returns to be submitted for these working capital loans or limits. And whether they are matching with the books of accounts or not, these quarterly returns. And if not, then give the details. So two things, working capital limit exceeding 5 crore, quarterly returns is equal to books of accounts, means matching with books of accounts. If not, then provide the details. So these are the two things you need to report in para 2, 3.2 of CARO. Clear? Any doubt? With para 3.2 of CARO?
Sir, say example, the company that CC limit for that utilized is 4 crore outstanding, but sanction limit is 6 crore. But we utilized only 4 crore. Whether this CARO is applicable?
Yes, because they are talking about sanction limits. They are not talking about utilization. So it is talking about sanctioned working capital limits.
Yeah, because here it's tricky actually. The thing is that if you are going with that utilization, then it will be a problem. Based on the sanction we need to carry out. Okay, sir. But that too at any time, any point in time during the period.
Yes.
Okay.
Okay. So two things, physical verification, sanction limits. These are the two things with respect to the inventory para 3.2 of the CARO. Okay. Now, let's go and check what is given in actual report so that we can understand about this. The inventories except for the goods in transit, if you see over here, the inventories except for the goods in transits were physically verified during the year by the management at a reasonable intervals. In our opinion, according to the explanation and information given to us, the coverage and the procedure of such verification by management is appropriate, having regard to the size of their company and nature of its operations. In respect of goods in transit, some goods have been received subsequent to the year end. No discrepancies of 10% or more were noted or noticed, okay, compared to the compared to the books of account. So there were goods in transit which could not be verified physically, so they have specified that. But apart from that, they have specified that, okay, they were subsequently received and there is no discrepancy. The second part is, according to the explanation and given to us, some working capital loan in excess of 5 crore were there, okay, on the basis of security of current asset. In our opinion, according to the explanation given to us, disclosed in the note 25 of the standalone financial statement, the quarterly returns or the statement filed by the company with such banks are in agreement with the books of accounts of the company of the respective quarters. Do you know what is 20.5 of standalone financial statement? I'm not sure how many of you are aware about the amendments that were there, I think 2023, yeah, if I'm not wrong, in 2023 with respect to the Schedule 3.
Yes, sir. There were amendment it has given like the aging report of debtors, creditors, those things has to be given.
So I'll show you one specific point because it is directly related to this particular part. Okay, it is
I
directly related to this particular part.
I think for that working capital limit also on the quarterly basis, the stock audit stock statement whatever given to the bank, it has to be matched with that books of account and the auditor also to certify that.
Yeah. See now, this is the Schedule 3, amended, updated as of today. Schedule 3, MCA website. Okay, you can go and check any point in time. Let me zoom in for you guys. Okay. Now, why I am taking you through Schedule 3? Because there are certain things which are already given in the Schedule 3 where management has to report. For example, title deeds of immovable property not held in the name of company. The same point was there in the CARO, but the same point is there in the Schedule 3 also as a responsibility on the management. If there are title deeds not in the name of company, the company has to provide this particular information. I'll not go in the detail of this particular information, but it is on the similar line what we have in the CARO. Same way, fair value of investment property, revaluation of plant property and equipment, revaluation of intangible, all these things are already there in your Schedule 3 as a disclosure by the management. So one responsibility is on the management to disclose. Second responsibility comes if the CARO is applicable on the auditor. Now this is division 2 where the Ind AS is applicable. So for sure there are high chances that the CARO will also be applicable. Then we were talking about with respect to the quarterly returns. If I show you details of Brainami property held and the proceedings, everything. Remember, we discussed about the Brainami property one also. Okay. Now, see, where the company has a borrowing from banks or financial institution on the basis of the security of current asset, it shall disclose the following. Whether the quarterly returns or the statement of current asset filed by the company with banks or financial institution are in agreement with the books of accounts. If not, summary of reconciliations, reasons of material discrepancy, if any, to be disclosed adequately. Means this requirement is already there on the companies. Management already has to report this point. In addition to that, auditor has to validate this. That's why when we were discussing now the report, they pointed to a particular note to the standalone financial statement where management has already disclosed this particular point. Clear? Any doubt?
Okay, sir. So with respect to the borrowing, working capital borrowing, if the company is borrowed from one bank, say example Axis Bank is a 3 crore sanction limit, and say example SBI is about 2 crore. See another bank is so and so. If we individually whether we will check or the cumulative basis we will check.
So for that, in aggregate already specified. So the clause itself says in aggregate from banks, plural, and financial institutions. So they have specified together.
Okay, sir. See, normally when they're sanctioning the working capital, sometimes the fund based on non-fund based also they will provide. Whether the non-fund based also will include in the limit.
As of now, there is no bifurcation on the fund based or non-fund based. If there is a sanction working and capital limit, it will be counted. But it should be based on security of current asset. So if you are saying non-fund based, then whether it is on security of current asset.
Yeah, security based on the current assets.
Yeah. So if it is in the security based on the current asset, those are only required to be counted over here. The purpose of this clause is to specify that where the current asset is the security and company is quarterly providing the information on the current asset, whether that information is correct or not.
Yeah, stock statement they will provide to the company on a monthly basis. Yeah.
Yeah. So in that case, they have to specify whether it is correct or not.
Yeah, to calculate the drawing power.
Yep. Again, the similar requirements are on the bank. We will discuss in the chapter when we will talk about NBFC or banks on this drawing power part. But there are also requirements on the banks for these quarterly returns. Okay. Now let's go to the para 3. Para 3, interesting one. It takes care for the loans and liabilities, loans and advances. Okay. So let's see what it says.
Whether during the year the company has made investments in, provided any guarantee or security or granted any loans or advances in the nature of loans, secured or unsecured, to companies, firms, limited liability partnerships or any other parties, if so.
So it says that whether during the year company has made investments in or provided guarantee, security, loans, advances in the nature of loans secured or unsecured to the companies, firms, LLPs, or any other parties. Covers everything pretty much. But if that is a scenario, then you need to specify some additional things. What are these? Like you need to check that whether these loans, advances, and everything which are given are of such nature. So let's see.
Whether during the year the company has provided loans or provided advances in the nature of loans, or stood guarantee, or provided security to any other entity, not applicable to companies whose principal business is to give loans, if
So first you check whether the loans has been given, advances has been given, securities has been given. If yes, if so, then during the year, the loans and advances or securities, loans, advance in the nature of loans or stood guarantee provided, okay, or security provided to any other entity. So first we will go to the loans and advances. First, you check on the overall umbrella level whether any investment, guarantee, security, loan is there or not. If yes, then now go one by one. So first we will take loans and advances. So loans and advances or guarantee or security, if these are given to any other entity, Not applicable to the company whose principal business is to give loans. Which are those companies whose principal business is to give loans?
Investment companies. Sorry.
Not only
Banking
investment
companies.
companies, but
Banking companies.
bank, NBFC, okay, any such entities which are banks or NBFCs, those are excluded. Those are not required to be considered in this particular clause. But apart from those companies, if any other company has given a loan, advance, guarantee, security to other entity, then what you are required to report? These two things.
The aggregate amount during the year and balance outstanding at the balance sheet date with respect to such loans or advances and guarantees or security to subsidiaries, joint ventures and associates.
So first thing is the aggregate amount of that loan during the year and balance outstanding at the balance sheet date, okay, to subsidiary, secure, joint venture and associate, means to kind of a related party. So aggregate amount plus balance to related party of such loan. Okay. Let's go for the B one.
The aggregate amount during the year and balance outstanding at the balance sheet date with respect to such loans or advances and guarantees or security to parties other than subsidiaries, joint ventures and associates.
So now here again we are talking about aggregate amounts plus balance, but to non-related parties. Okay, other than subsidiaries or joint ventures. So first you check any loan, investment umbrella is done or not. If yes, then check whether loans and advances have been given to the entities. If yes, then check related and non-related party to whom it is given, and you specify that particular thing. Okay, so here we are talking about loans, advances in the nature of loans, okay, stood guarantee and security. And then you have to bifurcate between subsidiary, joint venture, associate, and other than the subsidiary, joint venture, and associate. And for that, you need to provide aggregate amount and the balance outstanding. Okay. Let's go to the B point then. As per the B point, you need to specify
whether the investments made, guarantees provided, security given and the terms and conditions of the grant of all loans and advances in the nature of loans and guarantees provided are not prejudicial to the company's interest.
So now we are talking about investment, guarantees, security, okay, where if these are provided, okay, and the terms and conditions of grant of all loans and advances are prejudicial to the interest of the company. So now we are talking about terms and conditions of all loans and advances, and that terms and conditions are prejudicial to the interest of the company. If yes, then you need to specify that.
Sir, we have studied also in section 143.1 and the class A talk about whether the loans and advances made by the company or security, whether the prejudicial to the interest of the company or its members. There also we have studied this. We will encourage that if there is such a case, we will report there as well.
Yes. So there also you have the same reporting. Again, here also you can say it's an extended version of that reporting, because if I go to section 143.1, good, you pointed out that particular point. So if I go to section 143.1, what it says basically, it talks about loans and advances made by the company on the basis of security, whether they are properly secured and whether the terms on which they are made are prejudicial to the interest of the company or its member. but predominantly it covers loans and advances made by the company on the basis of securities. So it is narrow in the scope. Now, when you go to the CARO, if I go back to the CARO now, it is more wider in the scope because it's not only talks about the terms and conditions of grant of all loans and advances, but it talks about investments, guarantees, securities given, and the terms and conditions. So it's talking about more wider scope. And already we have seen whether secured or unsecured. So it does not bifurcate between secured and unsecured. So it is more wider compared to 143.1. So I can write over here more wide in scope compared to section 143.1. Okay. Now let's see the point number C.
In respect of loans and advances in the nature of loans, whether the schedule of repayment of principal and payment of interest has been stipulated and whether the repayments or receipts are regular.
So here, basically, we are talking about the repayment schedule, whether there is a repayment schedule, okay, schedule of repayment of principal and interest, or they are kind of given, without repayment schedule, payable on demand, and for indefinite period of time. There is no repayment schedule. And whether the repayments or the receipts are regular. So, repayment schedule and repayment frequency. Okay, that's the important point that we need to consider. Clear? Now, point number D.
If the amount is overdue, state the total amount overdue for more than 90 days and whether reasonable steps have been taken by the company for recovery of the principal and interest.
So, amount overdue more than 90 days. If amount overdue, total amount overdue more than 90 days. And the recovery of the principal and interest and steps taken. So, recovery steps plus amount overdue. Okay. That is the point number D that we need to report about these loans and advances. Very interesting point, this one. It's kind of a very interesting.
Whether any loan or advance in the nature of loan granted which has fallen due during the year, has been renewed or extended, or fresh loans granted to settle the overdues of existing loans given to the same parties. If so, specify the aggregate amount of such dues renewed or extended or settled by fresh loans and the percentage of the aggregate to the total loans or advances in the nature of loans granted during the year. Not applicable to companies whose principal business is to give loans.
Can anyone tell me what it means? What it means?
Restructure.
So,
Restructuring. Okay.
yeah, company already given the loan. The loan is outstanding. The person is not able to repay. Now again, along with the interest and outstanding, the company is giving fresh loan. They are closing the old loan.
Yes, absolutely correct. Absolutely correct. We generally see loans when they are, restructuring is used words when the company's principal business is to give loan. At that point in time, we use the word restructuring. Here in this scenario, it is not restructuring. What it is being done is loans were fallen due during the year. They have been renewed or extended to settle the overdues, or fresh loans granted to settle the overdues of the existing loan given to the same parties. This particular phenomenon, this particular situation is called evergreening of loans. that you mean that you are refreshing the loan when it becomes a due every time, that to hide its proper outstanding. For example, loan was due for 5 years. I paid an amount, like, I paid a loan for 5 years to someone. The person was supposed to pay me back. But on the date of payment, I paid him the amount equal to principal and interest. He returned me that back of that principal and interest amount back in lieu of payment of old loan. Now in my books, a new loan is appearing with a fresh outstanding, with a fresh, dates and everything and aging. So if I have to show someone, see, this is the loan I have given in current year, not 5 years ago. 5 years ago, loan already paid. That is known as an evergreening of loan. And if so, the aggregate amount of such dues, okay, percentage of the aggregate to the total loans and advances in the nature of loans granted during the year. So if evergreening is there, then you need to specify aggregate amount of such dues. Okay, aggregate amount of such dues and plus percentage of aggregate to the total loan. Aggregate amount by aggregate total loans or advances. You need to provide a percentage, that how much percentage is there of those total loans. Okay.
Sir,
Point number
good.
yeah.
So one query, sir. It's good to know that evergreening. What is the evergreening meaning here, sir?
You every time make it green, fresh. It is not going to, wither at any point in time. It is not going to go away at any point in time. It is fresh and green every time. That is evergreening of loan.
Okay, okay. Without without taking bath, putting sand and powder like that. Okay, sir. Thank you.
Okay. Now let's go for the point number F.
Whether the company has granted any loans or advances in the nature of loans either repayable on demand or without specifying any terms or period of repayment, if so, specify the aggregate amount, percentage thereof to the total loans granted, aggregate amount of loans granted to promoters, related parties as defined in clause 76 of section 2 of the Companies Act, 2013.
So now, if any loan is given without the terms of repayment, okay, without specifying the terms of repayment, or repayable on demand, which is equivalent to without specifying any terms of repayment. Repayable on demand means whenever company demands a loan, and company usually in this scenario never demands. So repayable on demand without specifying the repayment schedule. If so, then aggregate amount, percentage to the total loans, aggregate amount granted to promoters, related parties out of them. So without terms of repayment, then you need to provide aggregate amount plus aggregate amount by total loans percentage, plus you need to provide aggregate amount to related parties, aggregate amount to promoters, related parties defined in 76. Okay. So aggregate amount to related parties. These are the three things you need to provide when it comes to the terms, loans given without repayment of terms or terms of repayment. Clear? Any doubt with respect to this particular part, which is on the loans and advances? So we started with the loans and advances from this particular part over here. Third number, para 3.3, loans and advances given, you can say. So it has 5 points, like till F. which are required to be reported. Sorry, 6 points. Yeah. Any doubt with respect to this one? Okay, let's go quickly and see the audit report, annual report to understand this particular part. So it says the company has made investments in provided guarantees, securities, loans, and advances, and everything during the year, and for that it has, they have provided the information. So see how the information is provided. The company has provided loans and guarantees in respect of loans during the year, and details are given. Aggregate amount granted or provided during the year to subsidiary, joint venture, and others. Loans, guarantees both. Balance outstanding as at balance sheet date. Loans, guarantees both. The company has not provided advances in nature of loans to entity during the year, any entity during the year. So apart from these, other than the subsidiary joint ventures, they are not provided to anyone else. Second, investment made, guarantee provided. All above mentioned loans are, in our opinion, not prejudicial to the interest of the company. Third, schedule of repayment and principal and payment of interest has been stipulated and are regular. So there is no default. Fourth, no overdue amount remain outstanding at the balance sheet date. Fifth, fallen due during the year that have been renewed or extended fresh loans. So no loans were granted by evergreening. And sixth, which is no loans have been granted without the repayable on demand or without specifying any terms. So every loan has been granted with the repayment schedule. So this is how the reporting is done. Clear? Any doubt?
No, sir. Clear, sir. Thank you.
Okay. So that was your para 3 with respect to loans and advances or guarantee. Now this was, see, these are some paras, para 1, para 3, 3 basically. Then para 3-1, 3-3, and then you have other paragraphs of the order which are quite bigger in sense, okay, which are quite more detailed. But there are other paragraphs of the order which are not that much detailed. They are straightforward and simple. So you may find something, some paragraphs or some sections more complicated. Yes, they require some details, some more details compared to the other ones. So that is there. The best way to learn or to remember these particular paras and sections is to by understanding why it is there, what is required out of these. Okay, don't just go and mug up. Understand why these requirements are there, or asked from the auditor. Why auditor wants government wants auditor to specify these things in the audit report. What is the purpose? If you understand the purpose, then you will understand what to report easily. There will be no need to mug up these things. Okay. Now let's see the next point, okay, which is para 3-4. Straightforward, nothing difficult.
In respect of loans, investments, guarantees, and security, whether provisions of sections 185 and 186 of the Companies Act have been complied with. If not, provide the details thereof.
What is 185 and 186?
So 186 talks about loan to directors, sir.
And what is 186?
186, the loan or guarantee is provided to security given by any other company See, for first example, A Limited is there. It's giving on behalf of B Limited if any security is given, guarantee is given.
Yes. So basically, you're correct. So 185 talks about loan to directors. 186 talks about loan and investment by company. So if any, loan or investment or guarantee is provided either to director or to any company, whether the provisions of section 185 and 186 are complied or not. So compliance to section 185 and section 186 is something that you need to check as an auditor. Pretty straightforward. Nothing. You can say critical and complex over here. Straightforward. Check the compliance. Then 3.5. Let's see what 3.5 says.
In respect.
I hope the sound is it is audible, no?
Yes, sir. Sound is audible, sir.
Okay. Okay. Let's see what 3.5 says.
In respect of deposits accepted by the company or amounts which are deemed to be deposits, whether the directives issued by the Reserve Bank of India and the provisions of sections 73 to 76 or any other relevant provisions of the Companies Act and the rules made thereunder, where applicable, have been complied with, if not, the nature of such contraventions be stated. If an order has been passed by Company Law Board or National Company Law Tribunal or Reserve Bank of India or any court or any other tribunal, whether the same has been complied with or not.
So there are two things. One, whether deposit is accepted by company or amounts which are deemed to be deposits as per the directives of RBI or section 73 to 76 of the Companies Act, which primarily deals with the deposits, okay, have been complied with. So you need to check for the compliance of RBI directives, and you need to check compliance for section 73 to 76 of Companies Act. RBI directives plus section 73 to 76 of Companies Act for deposits. That is the first part. Second part is if there is a contravention. If not complied, nature of contravention you need to specify. You need to specify what was the contravention or what was not complied. Then, if an order has been passed by CLB, NCLT, RBI, or any other court or tribunal in respect of deposit, then whether that has been complied or not. So, order by CLB, NCLT, RBI, or others. Then whether it has been complied or not. So, order complied or not. So these are the two things that you need to specify in para 3.5. So one, directives or section 73 to 76 of the Companies Act for deposit. If contravention, then specify that. Number two, order by CLB, NCLT, RBI, others in respect to this, whether has been complied or not. Clear? Yes or no? Okay. So let's proceed further. 3.6.
Whether maintenance of cost records has been specified by the central government under subsection 1 of section 148 of the Companies Act and whether such accounts and records have been so made and maintained.
So section 148 of the Companies Act basically specifies to the class of the companies who are required to maintain the cost records. Okay. So there are class of companies prescribed for whom the cost records are required to be maintained. Now, if the company falls under that particular category, then whether the cost records, such accounts and records have been made and so maintained, if yes or no. So you need to specify and comment on the cost records. Now the question comes is, are you required to audit these cost records? So in order to comment whether such records and accounts have been made and maintained, are you required to audit them? Anyone?
No.
Then how can you comment whether these were made and maintained?
To see whether the company has complied with this, the whether cost audit records has to be maintained.
So yes.
If
The
there is,
auditor will get the written representation from the management whether that they are complete with the cost record, whether it is maintained for the product and services.
See, section 148.3 already prescribes an audit for these cost records. So section 148.3 says that whenever, like a cost record are required to be audited by a cost accountant. So over there, you can obtain a audit report by the cost accountant. You are not required to audit that. Okay. So auditing requirement is not there. Only you need to verify the compliance with 148.1. And if required, you can take a report which is prescribed under 148.3 by the cost auditor.
and here it is to be mentioned only whether the maintenance of cost records, whether cost records have been maintained, not about whether the cost audit is applicable or not.
See, now, if I take the audit report, if I go through the audit report, and if that is an unmodified opinion, by default, they are maintained. Otherwise, how the unmodified opinion has been issued? Are you getting the point? So by going through the cost audit report, I can easily understand whether they were maintained or not. That particular cost audit report will become the audit evidence for me, on which I can rely upon.
No, but there is a criteria. So some companies have to maintain only cost records, and the audit has not to be done in all the cases.
Yes. So again, if audit is not mandatory, I know in certain cases audit is not there. For certain cases, only records are required to be maintained. So if you have a report, you can go and check the report. That will give you an audit evidence. If you don't, then you have to go and check the records.
Sir, I think if for the company where the cost record not to be maintained, then that case the auditor will say that it's not applicable and the cost audit record is not. If it is applicable, then he will definitely refer that cost audit report.
Yes.
If there is
So if any of the clause here it is not applicable, for example, company has not taken any deposits. Okay. If no deposits have been accepted by company or there are no deemed to be deposit as per the directives, it is not applicable. Company has not made any investment or loans as per 185, 186, not applicable. So if anything is not applicable, we'll straight away specify that is not applicable.
Sir, in the case when the auditor find the cost record have not maintained, as is not complete, see, I think he will report the suitable comment in his report as well, auditor report.
Auditor's report, see again, why you will qualify your auditor's report for not maintaining cost records?
See, the thing is that it's a duty, right? We have to, they are asking the CARO, they are asking us to check whether the cost account record maintained as per section 148 or not. When there is a cost record is maintained, then it is okay. There is things. But when there is a cost record, as per the report, there is a comment in the cost audit report. Then auditor has to give some suitable comment for that, right?
Comment in CARO will be there, but I will not qualify my opinion on financial statement. So
No, I'm not talking about I'm not talking
so
about the
comment
finance.
over here will be yes. Comment obviously, yeah. If there is something which is not maintained as per 148.1, we have to comment.
See, cargo reporting will form part of the other regularities and legal requirement. From there only, we are giving that the internal control on financial matters as well the cargo is the 2 point. Is we will give the separate annexure for this. Under the cargo reporting annexes, this point we will specifically mention it.
Yes, yes, absolutely, yes. Any doubt? Any doubt till now, whatever we have discussed or whatever we have gone through with respect to the CARO? No? No doubt? Okay. If no doubt, let's go and see the annual report, how it is given in that particular annual report. So that will really help us to understand. See, over here, the company has not granted loans or provided guarantees as per 185 of the Act. The company has complied with the provisions of 186 wherever it is being, loans and granted on investment made. So they have specified 185 is not applicable, but 188, 186 is complied. So second, company has neither accepted deposit nor, any public or nor any amount which is deemed to be deposit. So this is not applicable. Hence, reporting under clause 3.5 of order not applicable. Simple. We have broadly reviewed the books of accounts maintained by the company pursuant to this as amended by the central government, maintenance of cost record under 148(1) of the Act related to the manufacturing activities, an opinion that the prima facie the prescribed cost records have been maintained and made by the company. So all these 3 points, they have specified that they have been maintained and are there by the company. Okay. So now what we'll do is, let's take some questions also on this particular topic. Okay. So we will see some questions so that we can understand in much more detail how to answer the questions on these topics. Let me take up some question. Just give me a minute. Oh, just a minute. It is taking a time. I'm stuck. Okay. So I have some small questions on CARO that will really help us to understand these particular scenarios. Okay. So this is basically multiple choice question scenarios that we have to answer. And then first we have a case scenario. So first we will go to the case scenario and understand the case scenario, and then we will answer the questions. So you are a statutory auditor of Precision Manufacturing Limited, an unlisted public company for the financial year 31st ended 31st March 2025. Let me read this particular question quickly.
You are the statutory auditor of Precision Manufacturing Limited, an unlisted public company, for the financial year ended 31st March 2025. The company's paid-up capital and reserves are 15 crores rupees, and its total borrowings from banks exceed 1 crore rupees. During the audit, you gather the following information. The company conducted a physical verification of its property, plant, and equipment, PPE, at the year end. A discrepancy was noticed where machinery worth 80 lakhs rupees was found to be missing. management has not yet written off the assets from the books. Additionally, the title deed of the main factory land, valued at 25 crores rupees, is held in the name of a director who retired from the company 2 years ago. The company has granted a loan of 2 crores rupees to a private limited company in which a director of Precision Manufacturing Limited holds 30% of the voting power. The loan is interest-free. The principal amount was due for repayment on 15th January 2025, but it remains outstanding as of the balance sheet date. The company incurred cash losses of 5 crores rupees during the financial year 2024-25. However, in the immediately preceding financial year 2023-24, it had reported cash profits of 2 crores rupees. The company was required to have an internal audit system. The internal auditor submitted reports for the first 3 quarters, which you considered. However, the report for the fourth quarter, January to March 2025, was not provided to you by the management, as it was still under finalization at the time of your audit.
So here, point number 3 and 4, I am yet to discuss from the Caro, but point number 1 and 2, we have already discussed from the Caro. So based on that point, we can take up some MCQs for further understanding. Okay. Now tell me one thing before we go to the MCQ. Point number 1, where you will report, how you will report. So let's take the question also simultaneously so that you guys can have option in. Okay. So here is the question number 1.
1. With respect to the reporting on property, plant, and equipment under Clause I of CARO 2020, what is the auditor's most appropriate reporting responsibility in this scenario? A. Report only the discrepancy of 80 lakhs rupees in PPE and state that it has not been properly dealt with in the books of account. B. Report only that the title deed of the factory land is not held in the name of the company and provide the relevant details. C. Report both the discrepancy of 80 lakhs rupees in PPE not being dealt with and the fact that the title deed of the factory land is not in the company's name, along with the required details. D. No reporting is required as the missing assets are not material compared to the value of the factory land, and the director is a known party.
So let's again let's read the particular part. Point number 1. You read this. Take a minute, read this, and then we will go to the MCQ again, because this is in connection. MCQ is in connection with this point. Done reading? Okay. Now, tell me what is the correct option for question number 1? What is the question number 1? Oh, answer to question number 1. Yeah.
C.
C would be the answer.
See?
Sir, here the two issues, sir, here the two issues are there. The 80 lakhs is a discrepancy has not been properly dealt with the books of accounts. But I think the one point is given, we studied that whether any discrepancies 10% or more in the aggregate of the each class of inventory noticed. In this case, the total value of inventory is not given. That is a one point I am thinking. However, the point is that it is discrepancies which not properly dealt with the books of accounts, and having that fact that the second case is very clear that deed is not with the company name. Company anyway, the company has to be reporting it, the description of the property, aircraft value, amount, name of the holder, all these things, as we studied, it has to be reported. That is very much clear. But on the point, 80 lakhs only, the total value is not given. Considering that case only, I am thinking about what is to be done. But most appropriate C is the option. Whether it is mark is provided or not provided, but I go with the point number C.
See, now, yes, C is correct. The reason because company conducted a physical verification. There was a discrepancy where machinery worth of 80 lakhs was not found or was missing. Okay, and the land which was valued at 25 crores was held in the name of the director. We have seen the same reporting requirement when you were, discussing one for Caro. So if I take you back to the Caro, see, for the plant property and equipment, whether these have been physically verified by the management at reasonable intervals. If yes, any material discrepancies were noticed on such verification, and whether the same has been properly dealt in the books of accounts or not. That's the point number B. Point number C is on the title deeds, which are not in the name of company. So here in this question, we have both. We have plant property and equipment, material discrepancy, which is of 80 lakhs, plus we have title deeds. So both of the points will be reported. So report both the discrepancy 80 lakh in PPV and the title deed not in the name of the company along with the required details. So the correct option is C. Okay, C is the correct options because as per the Caro point number, para 3(1) B and C we need to report. Okay, so let's go to the second number one. The company has granted loans of 2 crores to the private limited company in which the director of this company is holding 30% voting power. The company loan is interest free. Principal amount was due for repayment on 15, but it has remained outstanding on the balance sheet date. Where you will report? Where you will report? Come on, guys. I'll not go to the option first because I want answer from you. Where you will report?
Clause 4.
Okay. And what you will report? Basically, where and what you will report? That's the important part. What and where you will report?
It's a loan to the director. So this should be under section 185.
Okay. Anyone else with a different answer? Something different to add?
Sir, and also we have that in 143, 1A also, class A also talks about if any loans is given to whether it is prejudicial to the company. There also there is a possibility.
Where you will report? Very important. See, if I give you options, I think you will be able to give me the answer immediately. But I actually want an answer without an option from you guys.
This is I like you so much, sir, because of you. You are really ask us to think more and give the appropriate things. It's really a good way of doing this. Thank you so much.
Yeah, thank you. Break down the scenario sentence by sentence and then think what reporting requirement will come. Break down that. Very good, Ayush.
Yes, it would be a loan to a related party.
Okay.
So it will be under clause 3.
Hmm.
An amount overdue for more than 90 days.
Hmm. Okay. Amount overdue for more than 90 days. Yes.
Yes, sir. It will come under clause 3, sir. Clause 3 is loan given to subsidiary company, joint venture associate, all these things. But
Where? See, clause 3 has a lot of things in it. Okay. We need to understand where to report what. Now, this is the amount given to a private limited company in which director was holding 30% of the voting power. Now, if he is holding 30% of the voting power, what this will make?
it
Related
is
party.
interested, director directly interested on the company.
But I would say by making the 30% voting power, this company can be either a subsidiary, joint venture, or an associate for me.
So it's a related party.
Okay. So if I say
See,
it's not in subsidiary, joint venture, or associate, in that case, there are other clauses where I need to specify nature, like, the loans and advances which are given, whether they are with the schedule of repayment or not. And the terms of those loans and advances granted are in, prejudicial to the interest of the company. Now, here, if you see, you have a 2 crore loan given to a company which holds 30%, where the director holds 30% voting power. Loan is interest free. Now, interest free is prejudicial.
yes, sir, but it's not a associate and joint venture and a subsidiary, but it's a related party transaction.
Yes,
It-
it's a related party transaction. It's not a joint venture associate. Now, the
yeah.
question comes is
Yes, sir.
whether this.
Even the SBI LOD or regulation also is talk about more than 10 percentage or more. In that case, it talks about the related party.
So there is one more point that we need to understand. There is one more clause where we were talking about loans granted to promoters, related parties as defined in 276 of the Companies Act. In Caro, there is one more point where you have to specify whether any loan has been granted to the companies defined under section, related parties defined under 276 of the Companies Act. Okay. So will this company fall under that category of 276? Section 2, subsection 76, related party?
Yes, sir.
Yes.
Because a private company in which the director or a manager or his relative is a member or a director is a related party. Yes or no? So now coming to that particular, I'll take you to Caro again. So this company, private limited company, will fall under 276. Now, what we have to do is loans and advances in the nature of loans, repayable on demand or without specifying any terms of repayment. If so, the aggregate amount, percentage thereof for the total loans, aggregate amount of loan granted to promoters, related parties as defined in clause 76. So, here we need to specify if these loans have been given with which are repayable on demand or without specifying the period of repayment. If so, you need to specify the amount. And out of that, the aggregate amount of loans granted to promoters. Number two, loans which are outstanding. If the amount is overdue, state the total amount overdue for the more than 90 days and whether the reasonable steps have been taken by the company for the recovery of the principal and interest. In respect of loans granted to other entities, it is other entities, irrespective of related party or not a related party. Okay. So it says to any other parties. It does not restrict to related party or non-related party. Sorry. I think it was not visible. So the para 3.3 talks about to any other related party, any party. It may be related, it may not be related. So if an amount is overdue, state the total amount overdue for more than 90 days, and whether the reasonable steps have been taken by the company for the recovery of the principal and interest. Second, this entity falls under section 276 of the Companies Act. Then company has granted any loans and advances in the nature of loans either repayable on demand or without specifying any term for the period of repayment. If so, the aggregate amount, percentage, total loans granted, and aggregate amount granted to these promoters and related parties. We'll go back to the question. Question talks about 2 crore given to a private company. This is a related party. Okay. Now it is interest free. The principal was due for repayment on January 15, but it remains outstanding as on balance sheet date. Now let's go to the options. So this is question number 2, and these are the options. I'll quickly read the options.
Regarding the loan granted to the private limited company, which of the following statements most accurately describes the auditor's reporting duty under Clause 3 of CARO 2020? A. The auditor need only report the aggregate amount of loans granted and the balance outstanding at the year end. B. The auditor must report that the terms of the loan are not prejudicial to the company's interest as it is granted to a related party for business purposes. C. The auditor must report that the terms and conditions of the loan are prima facie prejudicial to the company's interest because it is interest-free, and that the principal is overdue by more than 90 days. D. The auditor should only report that the repayment of the principal is overdue and state the amount, as the interest-free nature is a business decision of the management.
So, what do you think? Which is the correct option over here?
C is clearly the answer.
That's why
C.
The longest
will
one.
be able to answer.
The longest sentence is the answer.
Yeah. So C is the correct answer, absolutely correct, because we are talking about loan which is prejudicial to the interest of the company and overdue by more than 90 days. Why we are not talking about the point number F, that the loan given to related party as per 276?
Sir, one doubt actually. See, loan overdue from 15th January. 15th January means January 15th is 16 days, February 30. It's not more than 90 days, right?
Repayment was due on 15th January. So,
15th January means 15th January means which year? Please go back to the question, sir.
yeah.
I am doubting whether it's 90 days is really we got it or not.
Let me also look into this, because yeah, it should be 90 days if I'm not wrong, but no, it is 75 days. It's not 90 days. Yes.
Yeah,
It's
only 75
days. Yeah.
How come it will be more than 90 days?
Yeah, it is not 90 days, but if the principal amount is due more than 90 days, then we have to report. But if the principal amount was not due more than 90 days, then we are not required to report.
Correct, but then the option C is not right? Then we would look at the other option.
But option C says that, okay, let me go to the option C again. It says that if is overdue by more than 90 days. That's why option C. If it is not, then it will not come.
See, if it is more than 90 days, sure, it is, we can report, no issues. But we can look at other option, what they are saying.
No. See, again, why option B will not be there? Because they are talking about business purpose. Business purpose is not correct. The loan is not given interest free because of the business purpose. Number one. Number two, aggregate amount is not required to be reported because there is a prejudicial to the interest of the company. Point number D, only report the repayment of principal is overdue, which is not correct. The interest-free nature is a business decision. That is incorrect. So point number C will be the correct because it says that prejudicial to the interest, and if it is overdue, principal amount, if is overdue by more than 90 days. If it is not, then you do not report. Okay.
I think that okay, more than 90 days. No, that is
But it is conditional if applicable. So it is said that if applicable, if it is overdue by more than 90 days. If not, then you are not required to report. But the main point is company's interest-free loan.
Okay, sir. In this C option, they given the if condition is put, then it's
Yeah,
okay. If there
yeah.
is no if condition, then
Then
if
it would
you
be it would be incorrect. But if it's there, that's why I say if applicable, then more than 90 days.
right, sir. Now it's clarified. Thank you so much, sir.
Yes. Any doubt on any of the part that we have discussed till now? Any doubt to any of the part? Any question that we have discussed? No? So we keep till here, and what we'll do in the next session, we will continue from here. We'll discuss the rest of the clauses of the CARO. If no doubts, then thank you guys. Thank you for participating in today's session. Thank you very much.
Thank you, sir.
Thank you.
Thank you so much, sir. Good night.
Thank you. Good night. Yes. Thank you. Good night.